Imagine a company as a building. To construct that building, you need money. Where does that money come from? That's essentially what we're talking about when we discuss capital structure. Capital structure, in simple terms, is the way a company chooses to finance its operations and growth. It's the specific mix of funding sources a business uses to get things done. Think of it like this. If you wanted to buy a car, you might use your savings, which is like using your own money. Or you might take out a loan from a bank, which is like borrowing money. Companies have similar choices when they need funds. They can use their own money, which in the business world is called equity, or they can borrow money, which is called debt. Capital structure is simply the combination of equity and debt that a company decides to employ. Equity essentially represents ownership in the company. When a company uses equity financing, it's like selling pieces of ownership to investors. These investors become shareholders, and they hope to profit as the company grows and becomes more valuable. Equity doesn't need to be paid back in the same way a loan does. Instead, shareholders benefit from dividends, which are portions of the company's profits distributed to them, and from an increase in the value of their shares over time. It's like planting a seed. You invest in the company, and you hope it grows into a big tree that bears fruit. Debt, on the other hand, is like taking out a loan. Companies borrow money from lenders, like banks or bondholders, and promise to pay it back over time, usually with interest. Think of it like a mortgage on a house. The company makes regular payments, including interest, until the entire debt is repaid. Debt can be a powerful tool for companies because interest payments on debt are often tax-deductible, which can lower a company's overall tax bill. Also, debt financing doesn't dilute ownership like equity does. The original owners retain the same percentage of control even though the company has taken on debt. However, debt also comes with risks. Just like with your car loan or mortgage, companies are obligated to make regular debt payments regardless of how well the business is doing. If a company struggles and can't make its debt payments, it could face serious financial trouble, potentially even bankruptcy. Too much debt can make a company financially fragile, like a building with too weak a foundation. So why is capital structure important? Because it significantly impacts a company's financial health and its ability to grow. A company with too much debt might be too risky for investors. Imagine a business owner who is constantly worried about making loan payments. They might be less focused on innovating and expanding. On the other hand, a company that relies entirely on equity might miss out on the benefits of debt, like the tax advantages and the potential to boost returns for shareholders. Using debt wisely can amplify returns, much like leverage can help you lift heavier objects. The ideal capital structure is not the same for every company. It depends on various factors such as the industry the company is in, its size, its growth prospects, and the overall economic environment. A stable, mature company might be able to handle more debt than a young, rapidly growing startup. Finding the right balance between debt and equity is a crucial strategic decision for any business. It's about finding the right mix to fund operations, fuel growth, and ultimately maximize the value of the company for its owners and investors, while also managing financial risk effectively. It's like finding the perfect recipe for a building's foundation, strong enough to support the structure, but also cost-effective and efficient.